Your work life insurance pays your family almost nothing. Here's the reality. Your employer's policy is probably 1x your salary, capped at $50,000. If you die tomorrow, your family gets 1 year of your income, and a funeral costs $10,000 of that money. You think you're covered. You're not. Most people never discover this until it's too late, and that false security is costing your family hundreds of thousands of dollars. This matters right now because 3 out of 5 American workers rely on life insurance from their job. That's 60% of the workforce, and most have zero personal coverage. Yet 42% of families would face serious financial hardship within 1 month of losing their primary earner. The median U.S. salary is about $59,000, so employer coverage averages less than 6 months of income. Your family needs 10 to 12 times your salary to stay stable. That gap is the difference between keeping your home and losing everything. Think of employer life insurance as a rain jacket that only covers your head. When the storm hits, you're not completely exposed, but your arms, your body, and your legs are soaked within minutes. You feel protected because something is covering you, but real protection means staying dry from head to toe. Your family deserves a roof in the storm, not just a hat that makes you feel safe while the rain pours everywhere else. 1. The $50,000 ceiling is a fantasy. Most group policies cap the payout at $50,000, even if your actual salary is $120,000. A median funeral in the U.S. now costs nearly $10,000 with a casket and burial. That single expense eats 20% of your entire coverage. What's left covers barely 4 months of your take-home pay, while your family still faces a mortgage, groceries, and years of living costs ahead. 2. Coverage evaporates the day you quit. Your employer's policy dies with your paycheck, and 1 in 4 workers change jobs every 2 to 3 years. When you switch jobs, you have to re-qualify for coverage, and if your health has shifted even slightly, you can be denied or charged double. Group coverage is temporary by design, but your family's need for protection is permanent. 3. Age is the silent premium killer. The same $500,000 20-year term policy that costs a healthy 30-year-old $27 per month jumps to roughly $58 per month at age 45 and over $120 at age 55. Waiting until you feel the need is the most expensive mistake you can make. The cheapest time to buy was yesterday. The second cheapest is today. 4. Health roulette is rigged against you. Around 20% of Americans live with a health condition, diabetes, high blood pressure, anxiety, that triggers higher premiums or outright denial when applying for individual coverage. Group policies skip medical underwriting entirely, so you never learn your true insurability until you try to buy coverage alone. By then, it's often too late for the best rates. 5. The 10x formula nobody tells you about. Financial planners recommend 10 to 12 times your annual income, plus debts, mortgage, and future education costs. At $59,000 per year, that means your family needs roughly $650,000 in coverage. Your employer's 1x salary policy leaves a $590,000 gap, money your family would have to replace by selling the house or pulling kids out of college. Number 6. The $30 fix that changes everything. A healthy 30-year-old can lock in a $500,000 term policy for less than the cost of 1 takeout meal per week. Even a smoker can get $250,000 for under $50 a month if they apply now. You don't need to cancel your employer policy. You need to add a personal portable term policy so your family gets the full amount when they need it most. Here's your one move today. Open your benefits portal, find your life insurance payout number, and divide it by your annual salary. If it's less than 10x, get a quote for a 20-year term policy right now. It takes 10 minutes and costs less than $30 a month. Your family deserves a roof, not a hat. And if you're wondering whether whole life insurance is worth the hype, watch this video next. The answer will completely change how you think about permanent coverage.